What are the advantages of an overdraft facility? Quick, convenient, and flexible. Interest is paid only on the amount of money borrowed and for the amount of time borrowed. What are the disadvantages of an overdraft facility? With high variable interest rates, the bank may not grant the facility and can remove it at any time. What are the advantages of trade credit? A business receives payment from customers before paying suppliers, removing the need to raise its own finance. What are the disadvantages of trade credit? Not all suppliers offer trade credit. Suppliers might charge a higher selling price. New businesses may only be offered trade credit once financial trust is gained. Long-term finance. Long-term sources of finance tend to be for larger amounts of money needed for longer periods. For example, startup purposes or business expansion. There are different types of long-term finance. What are the different types of long-term finance? Personal savings, venture capital, share capital, bank loan, retained profit, crowdfunding. Personal savings is money that has been saved up by an entrepreneur. This source of finance does not cost the business, as there are no interest charges applied. Venture capital. Venture capital is money invested by an individual or group that is willing to take the risk of funding a new business in exchange for an agreed share of the profits. The venture capitalist will want a return on their investment as well as input into how the business is run. Share capital. Share capital is money raised by shareholders through the sale of ordinary shares. Buying shares gives the buyer part ownership of the business and therefore certain rights, such as the right to vote on changes to the business. This can slow down decision-making processes. Advantages of share capital include: share capital is a source of permanent capital. Shareholders cannot have a refund on their shares. Instead, if they want to sell their shares, they must find someone else to sell them to. There are no dividends to be paid if the business has a poor year. Shareholders are not promised dividends every year, as dividends are only paid if the business has made sufficient money to pay all of its costs. Disadvantages of share capital include: it dilutes control for the founders. The more shares that are issued, the more shareholders there are who own part of the business. This results in the founders having less control. In order to have a majority stake in the business, the founders must hold more than 50% of the shares. The business is vulnerable to takeover. As a business grows and sells more shares, it becomes vulnerable to the threat of a takeover. This is because the shares are sold publicly, and if an individual or group buys enough shares, they can persuade other shareholders to vote for a new management team. Bank loan. A bank loan is money lent to an individual or business that is paid off with interest over an agreed period of time. Usually, this rate of interest is fixed. This means that the business knows in advance what the cost of borrowing will be and what monthly repayments will be required. This allows the business to plan ahead. To get a bank loan, a business must apply to a bank. The bank then carries out credit checks to see the financial history and reliability of the applicant. The bank may require the business to secure its assets against the loan. This means that if the business is unable to repay the loan, the bank can demand the sale of the assets to raise money to pay back the loan. If a business does not have enough assets, a bank may require a guarantor to repay the loan if the business does not make its repayments on time. Retained profit. When a business makes a profit, it can leave some or all of this money in the business and reinvest it in order to expand. This source of finance does not incur interest charges or require the payment of dividends, which can make it a desirable source of finance. Crowdfunding. Crowdfunding involves a large number of people investing small amounts of money in a business, usually online. Commonly used crowdfunding websites include Crowdfunder, GoFundMe, and Kickstarter. Advantages of crowdfunding include: it acts as a form of market research. If people don't invest, it means the business idea is not attractive or distinctive enough, indicating that the business is likely to fail. It provides opportunities for individuals to start up a business, even if they don't have access to other sources of funding. Disadvantages of crowdfunding include: the business must be interesting. Crowdfunding is most successful when the business idea is appealing, interesting, and innovative. It can be difficult to reach the funding target. Statistics from crowdfunding websites indicate that less than 33% of businesses achieve their funding target, an item of property owned by a person or company. Cash flow, the movement of money in and out of the business. Cost of borrowing. Cost of borrowing is the interest charged on a bank loan. Credit arrangement. A credit arrangement is a contract made between a business and a supplier. It outlines when payments must be made. Credit check. A credit check is when a company looks at the financial information held on a business or an individual to determine whether they are creditworthy, e.g., suitable to lend money to, and reliable. Crowdfunding. Crowdfunding is raising money from a large number of people who contribute small amounts, usually online. Dividends. A sum of money paid regularly by a company to its shareholders out of its profits. Entrepreneur. A calculated risk taker who sets up a business in return for financial gain. Founder. A business founder is an individual or group of individuals who create a business. Guarantor. A person who guarantees a loan or payment. If the person or business taking out the loan does not pay, the guarantor pays instead. Investment return. The amount of money that is received in return for investing in a business. Ordinary shares. A share of a company entitling its holder to dividends which vary in amount depending on whether the company has a good or bad year. Overdraft. An agreement with the bank to overspend on an account. Permanent capital. Permanent capital is a source of finance that never has to be paid back. Share capital. The money raised when a business becomes a public limited company by offering shares in the business in return for capital. Shareholder. A part owner of a private or public limited company. Trade credit. The ability to buy stock now and pay for it at a later date. Venture capitalist. A venture capitalist is an individual who invests money in a startup business in return for a share of the business and or the profits.